Well, good afternoon. Welcome to today's FS Club webinar on the subject of Is ESG Dead? An investigation of investor returns. I'm delighted that we are able to welcome Carla Nunes to talk to us this afternoon. Carla's in America, so it's very much the morning for her, but it's a very rainy afternoon here in London. You've probably seen my face before. I'm Mike Wardle. I'm the Chief Executive Officer at CEN and our chair for today's event. My job is very much to set the scene, then get out of the way so we can hear from Carla and her presentation. A brief word of thanks, first of all, to our sponsors. We're very fortunate at the FS Club to have a wide range of sponsors who support our work and enable us to run these sessions and supporting the work we do across the board. The program for today is quite simple. I'll do the introduction and some of the housekeeping. We'll have around about a 20-minute keynote presentation from Carla, and then there'll be a Q&A session at the end. If you haven't used GoToWebinar before, the way to put in a question or an observation is to find the questions tab on the dashboard on your screen. You can type in your question and that'll come to us for the Q&A session. You can of course put in your question or comment at any stage during the presentation. So if you have something that's burning, please do put it into the questions as it comes up. We will pass on contact details for anyone who asks a question to Carla, so if there's any need for any follow-up emailing and discussion, that can be made easier. And finally, by way of housekeeping, we're recording the webinar this afternoon, so if you want to go back and remind yourself of the content, you will be able to, or if you have friends and colleagues who you think might be interested, you can share the recording with them, and that should be available on our website in the next 24 hours or so. But it's a real delight to welcome Carla Nunes, Managing Director at Kroll in the Office of Professional Practice, with over 25 years experience in this world and providing firm-wide technical guidance on a variety of valuation, financial reporting and tax issues. I'm sure Carla will tell us a bit more about her current work as we go through. Carla, we're delighted to welcome you to today's webinar. Over to you, the floor is very much yours.
Well, thank you so much, and thanks everyone for having me today. And I do hope your summer gets a little bit better than what it's been so far. So I'm just gonna, for a second, let me just make sure that I'm sharing my screen appropriately so you can see it in full screen mode. As I said, my bio is here, but just relevant to this topic, a couple things. One is I am a co-author of Kroll's ESG and Global Investor Return Study, and we'll talk about that somewhat in detail of the results we've gotten. And I've done some work with the Wharton School of Business, on ESG, and I am actually part of a working group on ESG related topics as part of the IVSC, International Valuation Standards Council, and I'll talk about that in a second. So as a disclaimer, these are my opinions, not necessarily of my company, Kroll. And here's what we're going to cover. Just a brief overview of what the current ESG environment, and you can say ESG or sustainability environment today. Then we'll talk about the results of that study that I just alluded to earlier, and then we'll give some time for Q&A. So what is the current environment? Well, it depends on which country you talk about. But one of the things that it's with the politicization of the term ESG, we're seeing a morphing of terms. So it used to be that, sustainable versus ESG concepts were actually distinct, meaning a sustainable investment was a broader concept, and it was really more concerned on how a company or an investment impacted the world. So an outward perspective, whereas ESG as a concept, as an investment framework, when it was created, it was really looking at how the world impacts a company or investment. So what is the impact to a company's bottom line? And that's the focus we actually took when we did our Kroll global investments return study. The other themes that now we're seeing talked about more commonly is in order to avoid, particularly in the United States, but it's true also starting to be in some corners of Europe, the term ESG is considered like a dirty term, right? And nobody wants to use that. So either people are using the term sustainability or they're going by thematic type of investments. So it might be a specific climate, climate tech, or some other type of climate related topics, energy transition, green something, as opposed to specifically talking about ESG. And of course, in the context of private equity, we hear a lot about impact investments. That context, impact investments are those that really have a connection between an investor's values, and by values meaning like what they care about, but they also want to show specific metrics that they are being quantitative, they're being achieved. So that's like another theme that we're seeing. SRI, of course, there was like around since a long time ago, and it was really about the concept of sin stocks. Let's do like negative screening and don't invest in those types of stocks, versus now there's also positive screening. As an example, let's invest in some energy companies that to push them to go into an energy transition faster. So that's an example of how you might see an SRI type investment. So honestly, like, how did I get interested in this topic? It started with like in 2020, I am part of our our global office that helps teams around the globe with, difficult questions around valuation, corporate finance, financial reporting, tax, what could impact the valuation. And I started getting a couple of questions asking, well, my client or the auditors asked, how do I incorporate ESG in the valuation of an investment or a firm? Honestly, I was like, I don't know what ESG is. This was in 2020. So I started doing a lot of research on the topic, and I realized that, it was getting very popular. But there was, after that big, um, energy towards, and no pun intended, energy towards like investing these types of called ESG themed investments, or the companies saying that we're so good. The reality is that there's been a lot of accusations of greenwashing. So meaning that obviously companies and funds would disclose what would make them look best, and not necessarily look at like other risks and things that would make them look worse, right? And that came because a lot of lack of consistency and standardization of what these terms meant. And there's this non-for-profit organization called Carrots and Sticks, and they put it together a list of how many voluntary versus mandatory sustainability reporting provisions are there in the world. And in 2023 they expanded their database to include 130 countries. And back then there was, about 2,400 provisions. That's a lot, but about more than half, 55%, were voluntary. And of course, as you know, as I just said, if it's voluntary, you're just going to show those that portray you in the best light. So as a result of those accusations, we've seen a lot of standard setting and regulatory trends, some of which may impact companies around the globe. And because they are so pervasive, like they are very worldwide applicable. And so these obviously is not an all-encompassing list, but just highlighting some of the important ones. And this is on the corporate side. I'll have another slide on the fund side. But this accusation of greenwashing and the desire by investors to invest in these types of themes led to the creation of the International Sustainability Standards Board, or ISSB, and that's the one there on the left. They issued their first two standards, one with general requirements and the other climate-related disclosures, um, back in June of last year, so almost a year ago. And the first, obviously, the adoption is going to depend on jurisdiction by jurisdiction. It really means that whichever country decides to follow ISSB would have, mandatory, not mandatory, but like they would have requirements. If they're made mandatory by the jurisdiction, they would have to disclose information based on that. And so the first ones that could potentially already disclose something following these standards is next year with data from this year. The European Union, the CSRD, the Corporate Sustainability Reporting Directive, is also very pervasive. It's been watered down in terms of when does it apply, but any company that has operations um, in Europe, in the European Union, could potentially be brought into this and be required to disclose. I know for a fact of like a number of US companies that are getting ready to disclose starting next year with data from this year. And this was also the final set of standards was issued. The ESRS, they were issued back in last year around the same, like June, July of last year. Now, the UK, like right there, front and center, is, there's been some recent changes on the timeline, but there's been a decision to follow ISSB. So the idea is that they will be in line and they only diverge if there's specific UK issues that need to be addressed. Otherwise, they'll be similar to the ISSB standards. And right now, the tentative dates are to endorse these standards in the first quarter of 2025. And then the effective date would be January 1st, 2026. Obviously, some UK large companies are probably already reporting a lot of the information, particularly when it comes to climate, not just ESG, but relative to climate. A lot of these standards were based on the TCFD, so the Task Force for Climate Disclosures, financial disclosures, and so they might already be collecting this data, but it may have to be presented or disclosed in a different manner. The big question is the US. The US is, after all, like a big financial market, and the reality is that a lot of UK companies, European companies, etc., trade in US exchanges. And the moment you are trading in the US, you have to worry about the United States Security and Exchange Commission, or SEC. Even though companies might be disclosing under IFRS, they still have to meet the requirements by the SEC. And so in March, the SEC issued its final climate-related disclosures bill, but it was immediately put on stay, meaning like it's not being applied yet. And because there was so much pushback from both sides of the aisle, the non-for-profits that really have as their focus as saving the planet, they thought that the SEC proposal versus the final was too watered down, so they removed a lot of the required disclosures, and they thought that that was not enough to protect investors, versus preparers and other groups that said this is an overreach of the SEC's regulatory mandate, and so they're suing them to not have this rule be applied. So we'll see what happens, but the reality is that a lot of companies are preparing as if they would have to apply it. And then finally, the state of California, and the only reason I mention it is because some of these rules are very invasive, meaning if a company has worldwide sales of half $500 million, or in another standard, $1 billion, you will be mandated, even if you just have $1 of sales in California, to disclose, in accordance with this regulation. So you can be inadvertently falling into the state of California rules without even realizing. On the fund side, they were actually far ahead in the EU with the disclosure of what constitutes the types of investments in this space. And so they're sort of known as Article 6, 8, and 9. There was a lot of change in what the funds names are. And that's because they were afraid of not falling under the regulation, the SFDR. That I think is stabilizing. It may change, for example, in the UK a little. The UK has recently passed or became effective the anti-greenwashing rule. And one of the things that it does is there's an SDR, like a UK Sustainability Disclosure Requirements rule, that talks about the labeling. So the idea is that if you have an investment that is called, say, ESG, this new rule says, well, you have to have at least 70% of your assets your investment assets under management need to be in that theme. Now, ESMA has just put a similar rule for the EU that is actually more stringent. It's 80%. And the SEC in the US also passed a rule that says 80% is, they call it the fund names rule, that you have to have investments in that theme, if you want to call it climate or ESG or whatever it is. So that's things that the fund industry had to deal with to comply with these rules. So finally, on the regulatory standpoint, this is not exactly something that impacts everyone, but the International Valuation Standards Council is a supranational organization and for profit. They're actually based in the UK, and they set out standards for, almost like the minimum that you have to do when you're performing valuations under these standards. And in some countries, particularly in Asia, they actually adopted IVS, so International Valuation Standards, as something that for regulatory purposes, if you do a valuation, you have to comply with these rules. In the US and Europe, it's not mandatory, but some professionals will follow this when coming up with the value of an asset or an investment or real estate property. And so one of the things that the IVS recently issued standards that will be effective in 1 January of 2025 is the fact that you are now supposed to consider ESG factors when coming up with the value of a company, an asset, or a liability. And you are supposed to be aware of relevant legislation and frameworks in this space that could impact your valuation. And so the one thing that is challenging at this point is the lack of consistent data. That's what the standards that I just talked about are supposed to give investors, is to give a measurable framework that is consistent across the board, and all of those standard setters are working to interoperability between them. So meaning if you are complying with one, you would also comply with the other. But now IVS is saying, well, you need to consider those standards and those factors to see if they're material, and you should you reflect them in your valuation if that's the case. I am part of the working group on ESG on that the IVSC has, and we are analyzing a survey that we have sent across the globe recently. We have about, let's say, 500 responses, so it's a good response rate so far. I mean, it's a preliminary, but there's majority of professionals are not yet reflecting ESG factors in their valuation. So this is just a preliminary finding, but we'll be analyzing the data more carefully. So with that, Let's go back to the not don't go back, go to the results of this ESG and Global Investors Return Study. So with all of that backdrop of new regulatory environments and the fact that it's still hard to reflect these factors in valuation, when we started our study, we thought like, well, let's see what academic research is out there. Is there evidence that investors care about ESG? And there are two types of studies broadly speaking, in this topic. One is like corporate studies, where they're looking at, if adopting ESG or sustainability investing principles will impact the firm's financial performance. So that means like, are they impacting your cash flows or your cost of capital? Investor studies refer to like market performance of like ESG funds, portfolios, indices, compared to say traditional ones. So it's more like an asset manager perspective. What we found by doing a somewhat exhaustive summary of the academic research, which by the way is already outdated. Our study was launched in September of last year in 2023, and since then. A lot more interest has surfaced in this area from academics. So there's a lot more studies out there already in terms of what they're trying to find these types of relationship. But what we found in general was, number one, there were mixed results. Some would find relationship between sustainability and cost of capital or valuation. Some would find negative or non-existent. The other important factor that was found is divergence in ratings assigned by rating agencies, specifically related to ESG. And that really comes from different methodologies and what they're trying to accomplish. But that's been like a lot of topic and discussion, and there's more regulatory action coming as a result for agencies that provide ESG or sustainability ratings. So our study, as I said, was released last year in 2023. We wanted to do a global study. So our study actually includes over 13,000 publicly traded companies across the globe and across a variety of industries. We used MSCI ratings, and we'll talk about that in a second. We then bifurcated the global results by 4 geographic regions: world, North America, Western Europe, and Asia Pacific. And for those countries that had enough of a sample size, we also looked at their overall results, and that included 12 countries / markets that we looked at. Finally, we looked at the results by industry. So we'll just show you like the results just for a couple of instances so you can see what they look like. You can always go to the this link to get a dynamic, interactive dashboard where you can look at your own industry that you are interested in, or your own region or country to the extent it's available. So this is just really to give you a flavor. But why did we get MSCI as our source? We actually interviewed a number of ratings companies, and we were interested for this particular study, like in a number of things. One is that the coverage period was the longest possible. Otherwise, you cannot really draw a trend. Because if what you see a lot of times in the newspapers is just, oh, what it looks like last year, or what looks like a single year. That's not a really good study to see long-term trends. So we wanted a long-term coverage period. We also wanted to be global, so it had to be a rating company that had a lot of companies being rated. The other thing we were interested is how often they re-rated. So, for example, one of the companies we interviewed, they only changed their rating once a year. And what we wanted to do is, if there's a big controversy and something has changed in the profile of that company, we should see a new rating. And MSCI fit that criteria, meaning they are pretty stable over time, but if something happens, they might re-rate more than once a year. And then generally in the ratings methodology, meaning we were focused on what is the impact of these ESG factors in terms of risks and opportunities for the company, as opposed to some other methodologies which they were just looking at how good is the company doing for the planet or for its people. And really we were focused on the returns of these companies. So we were focused on how much do these factors are really impacting your bottom line. Now, this is a number of companies that were rated by MSCI over time. And as you can see in the dark blue area, is that there was a significant increase of number of companies being rated in 2013. And so because we wanted a global study that had a significant sample size, we couldn't really use the period prior to 2013, because once you bifurcated by region and by industry, you would lose out a sample size that would render your results not as meaningful. So we only focus on the period of 2013 through 2021. The other thing to note is that ESG ratings, even though they have letter ratings in the case of MSCI, they're not the same as credit ratings. Because if you think about it, credit ratings that only focus on one thing. Do you have enough cash flows to pay off your debt obligations? So they're focused on a much narrower set of issues. Whereas for MSCI and other ESG ratings is the overall company. So it affects equity holders as well. And the way that MSCI has their ratings is also uses letter ratings, AAA through CCC, and they bucket these in like leader, average, and laggard. And these are the things that we're going to show you in terms of the results. And this is sort of a bell-shaped curve. What does that mean? It means that there's a lot more companies that are rated average than leader and laggard. So there's like leader, there are fewer leaders and fewer laggards compared to the average. And the ratings are based on a relative statement within your industry. So you might be a AAA rated company in your industry, even though if you were to compare yourself with another industry, you might not score as well, in this particular environmental, social, and governance factors. We used overall or composite ESG ratings. What does this mean? Think about Tesla, right? Tesla, they score very well on the environmental front. However, because of social and governance issues, they're actually not rated as AAA. They were for a moment there, but then they got, as the issues start being more prevalent in terms of social and governance, they got downgraded. They're still very good at the end of our study period. They were a single A, but they were no longer considered leaders in ESG. So just to give you an example of, we're considering a composite rather than environmental, social, or governance individually. What did we do? And like we'll show you the results in a second. We created portfolios or indices that were comprised of companies that were just rated AAA, AA, single A, every single month. So every single month we constructed our own portfolio of companies that had this MSCI rating. And then we computed like the total returns. Say, if you invested $1 in December of 2012, what it would grow to be at the end of December 2021. And then because people care about annualized returns, we converted that cumulative return into an annualized. All of these returns were market cap weighted, meaning, a company that is larger will have a bigger weight than a company that is smaller when coming up with these returns. And finally, we had to denominate everything in a single currency, and we chose US dollars because otherwise we wouldn't be able to, compare returns across companies. This is a number of observations that we have, during this period, and to show you the preponderance of the 4 biggest countries represent about half of the observations, and that's US, Japan, China, and the UK. Now, what are the results? So I told you, like, if I invested $1 at the end of December 2012, what would I get at the end of December 2021? And the strong, like the green line on your chart shows that $1 would grow to $299 dollars to at the end of the period, and that outperforms both average and laggard rated companies. It also outperforms the benchmark, which is the MSCI All Country World Index, which is the dotted gray line. But as I said, we care about annualized returns. So this is what it looks like. Leaders earn on average 12.9% compared to 8.6% for laggards. That's almost like a 50% better during this period. Now, these things can be completely different if you add, as you add more observations to the analysis, but this is what during this period, companies that were performing better in ESG categories, they were also earning higher returns. To give you a sense of how many companies were considered leaders versus laggards, you can see here what they were at the end of December 2021, because every month it will be different. The composition will be different. But so at the last column there shares the company count at December 2021 and what was the proportion relative to the total. So there were about 13% of companies worldwide that were considered leaders in ESG and 24% that were considered laggards. So a little skewed towards the laggards, but just it follows that bell-shaped curve that I was telling you about earlier. Now, what does that mean for European companies? And these are Western European companies, including the UK. And we saw a similar pattern in that leaders outperform laggards, but the proportion or the difference between laggards and leaders was not as large, but it was still significant. Importantly, laggards versus average was not that different. But let's see the composition of companies in Western Europe in terms of their ESG ratings. And what you find here is that Europe is far ahead of the regions in terms of ESG, in their ESG journey. So over a third of companies were considered leaders in Europe, and only 6% were laggards. So it makes sense that there's so few companies compared to the overall that there's not a huge distinction between laggards and average. But clearly the leaders were outperforming versus the rest of the pack in terms of based on MSCI ratings. This is actually, UK had enough data to show it, show it independently. So as you can see, it follows the same pattern: 18% for leaders, 12.1% for laggards of this period. The overall companies that were, for the UK, they had a 14.9% return for this period of the companies that had a rating. So we can still see an outperformance by the leaders even compared to like overall market. Now, the UK was by far the best country in everything that we analyzed in terms of where companies were in their ESG journey. So 41% of companies were considered leaders in ESG in no other country. Now, of course, depending on how policies change over time, and we know the conservative government was delaying some of the green, green targets for the UK economy. Now we have a new government, Labour government, so we'll see how that progresses. But at this point in time, the UK was definitely considered like outperforming everyone else in terms of in their how far they were in their ESG journey. Finally, just for comparison purpose, is just showing you North America. The same pattern emerges where leaders outperform laggards, but only 10% of the companies were considered leaders. So they are farther behind in their journey in terms of ESG is concerned. And now finally, I'm going to give you a couple of examples of industries, because a lot of people in media just make these statements that say, well, the only reason why companies during this period outperformed in ESG is because it was driven by technology companies. And if you strip out the technology companies, the results don't hold anymore. Well, that's not what we found. What we found, and this is for Western Europe, but this would have been true for globally, that, for example, this is just an example, industrials, we see the same pattern that leaders outperform laggards. However, the industry performance does change depending on the region. And in some cases, we get the opposite results. So this is an example. In this case, technology was actually the opposite. So laggards outperform leaders in Europe. In the US was a different trend. So in Europe, we have the laggards outperforming in technology. In the US, we have the leaders in tech, outperforming in ESG. But what I'm saying is that it's not just an information technology story, number one. Number two, depending on the region you look at, you might have different results. And so the idea here, and I'm like sort of finalizing almost, is the takeaways is that, overall, you saw a bigger performance by those portfolios that were focused on leading ESG companies as rated by MSCI. Regionally speaking, we only had two exceptions where this didn't happen, which is Brazil and Germany. In terms of industries, in most cases, yes, ESG outperformed laggards, but there were some cases where, for example, average companies were better than the rest, or a couple of companies that, like technology in Western Europe, it was the opposite. And so for people who are evaluating investments and looking at expected returns versus, you're looking at the cost of capital and discount rates, this is not a straightforward exercise. And so what we're seeing is that, in addition, there's some caveats, because with the politicization, like, the investor appetite could change and you could have fewer dollars going into these types of funds. Also, they could be called something else. The beauty of this study is that we were not looking at specific investment portfolios that are out there. We're looking at companies that are rated in these categories. So we think it's a little bit immune to that, but it's a caveat. Now, where could I actually see this impact? We're thinking more about, the cash flows. So think about, for example, companies that are in areas where you can't get insurance protection. In the United States, this has been like a huge, huge issue in Florida, Louisiana, for example, where you can't get protection against hurricanes, tornadoes, etc. And in California, where you can't get insurance for wildfires. And you think about, in Europe, there's been a lot of wildfires, and that's starting to be an issue. So if you can't get insurance protection for these types of events and they become more prevalent, guess what? That's going to impact your bottom line in a negative way. You're going to have negative cash flows that you're not, prepared for. So that's an example of how you'd reflect this in projected cash flows. Or employee attrition. So if you are a company that everybody loves to work for, you have less attrition. You don't spend so much in training and hiring costs, in lost productivity, because you're not like getting people up to speed. And so these are a number of areas where you could see the projected cash flows, how these issues could impact your valuation. Discount rates, a little bit wait and see. However, there is this Moody study recently that they said that companies that had better ESG ratings also tended to have better credit ratings, meaning they may face a lower cost of debt. And so that impacts, directly the discount rate on the cost of debt category. So finally, and this is the final two slides, is before we go to questions, is an analysis by Professor Alex Edmonds at LBS, at London Business school, and he was making a case. He's very well known in the area of ESG and sustainability, and he was making a case precisely of what I just said, which is the main effect of these risks related to, energy transition and ESG factors should be seen in the expected cash flows rather than on the discount rate. The discount rate is more of this would be a company specific risk, and it could become a very ad hoc adjustment, and you could be under or overestimating the risk by making those adjustments. So his proposal is that you focus on how these initiatives would impact a firm's or an investment's cash flows in order to decide how to incorporate them. So with that, I'm going to stop sharing, and I will go back to the Q&A.
Super. Thank you so much, Carla. A run around some really interesting data. We've got quite a few questions, so we're going to have to go quick fire, I think, through some of these. First of all, Sue Milton's asked how sustainability materiality, is applicable to a company, and how does that affect the categories of the leader, average, laggard that the company is judged to be in?
That's a great question, because at the end of the day, we care in looking at any investment. We look at any risk that is material for the firm. So if there could be a lot of risk that you're facing, but if it's not material to you, they wouldn't be incorporated. So, and that's reflected also in the rating. So if you don't use any water, for example, water usage is not going to be a material impact for you, and so that will not really impact your rating.
Cheers, thank you. Derek Scott's got a sort of question on the International Valuation Standards, and just wondered why they exclude pension obligations, which is maybe a technical question, but do you have thoughts on that?
I'm not sure if I know like pension obligations would be excluded, because there are some pension in some countries. There are pension institutional investors that will use IVS as a focus or a lens to see how to value their investments. So, but pension liabilities in general is not just an ESG focus. Like I always think of that as a potential risk factor that you have to evaluate in evaluation. It's not unique to ESG, and I personally include that when I'm doing valuations of entities. I include that as a deduction to get to the value of equity.
Thank you. Derek Scott's interested in the weighting given to E, S, and G. There's many different scoring systems out there, but are they generally given equal weight, or is more weight given to environment than the other factors?
It actually depends on the companies that are rating, that the agencies that are providing the ratings, and so some of those that are just focused on what's the impact of the company on the planet, people, and environment, they might focus more on the E. The MSCI was more balanced in terms of the weights. So it really is going to depend on which agency you're dealing with.
Sure. Ajay Obe has got a question. He's just reflecting on Scope 3 emissions and the fact it's very difficult to calculate because of the complex supply chain issues involved, and comments that lots of multinationals have operations in the developing world where there are few or no frameworks for measuring ESGs. Just wonder whether you have thoughts about how to apply some of the ESG measurements to these issues when that's the situation.
That's a very tricky and a pertinent question. So there are a number of emerging markets that are actually going to adopt ISSB standards. So Brazil is an example. There's a number of Asia Pacific countries that also said we're going to adopt ISSB, maybe with some changes. And my question is like the challenge of actually getting that information from local companies when they don't even have like other basic financial information sometimes. And so scope 3, and I think that's part of the reason why the SEC, for example, watered down their proposal into the final. They decided to exclude scope 3, and they now call it voluntary. If you want to disclose, fine, but they're not going to mandate it. And that's the one that it's going to be I believe, like very difficult to account for. And that's also an area where auditors, because a lot of these disclosures will go through assurance. So these standards are mandating that someone verifies your statements, and that there's going to be a lot of weight put on the shoulders of the companies who are auditing these disclosures, because they're going to have to find that proof that disclosure is appropriate. I don't envy that task, I have to say.
Thank you very much. We're going to go run a little bit over time. I hope that's all right with you and everyone else. Just
Yes.
we do have a lot of questions to get through. Rob Billman has asked whether there's any easy to apply indices by which to compare companies, and I guess the MCSI rating system is such a thing. Are there other sort of easy to apply indices that you can think of?
So MSCI is like the gold standard right now, for sure, but it's also expensive. So that's a challenge. I do know that there's other entities that or that are trying to develop. So, for example, Moody's and MSCI just came into an agreement to collaborate and merge their databases. So it's an example that I'm curious to see what's going to happen with that and what changes will be made. There are other scoring, like Capital IQ will have something there for those of you who use Capital IQ. And there's a number of companies. It's still the Wild West. I'm gonna be frank. It's still the Wild West, because a lot of new providers, startups are coming out and saying, oh, this is a better way to put, for example, for portfolio valuation, for your portfolio companies, here's how you'd rank on these factors and how you compare to average. And I think that is still going to evolve as more of this information becomes available based on the new standards that are mandating information to start being disclosed already next year, in a comparable format. So I think this is an evolving place, and we'll see a lot of development in this area in the next couple of years.
Thank you very much. And Sean Guthrie's commented that laggards could include companies in distress that don't have the means to invest or to push forward ESG initiatives. And being in distress would usually mean a lower compound annual return. Does that feel right to you as a way of looking at the laggards?
Um, it's not exactly like we did look, and we're actually looking at a little bit more into it, like whether size is an issue. By the way, MSCI actually has a different study that they put out recently, not the way we did it, but they looked at whether size was an issue as opposed to just the stress. And because some people will say companies that are very large, they have the capital to invest in these initiatives and to disclose the information, so they'll look better than smaller companies that don't have the resources to do so. But what they found is that even controlling for size, they still saw outperformance by the leading rated companies.
Thank you. Sue Milton's just commented, it's great to see progress, but are we sort of fiddling while the earth burns? Too many standards, adoption too slow, just not moving fast enough?
Yes, that's definitely an issue, and unfortunately, I mean, the economy bears a significant component in this. Meaning, when we were living in a world of ultra low interest rates, it was easy to say, "Hey, let's invest more in renewables, energy transition, etc.," because it's cheap enough from a cost of capital standpoint to develop these projects. When interest rates went up around the globe, it's particularly like in the Western economies, they're still low by the standards of, say, the 1980s or the 1970s, but you're going from an era of like negative or zero interest rates to like something well north of that. And so a lot of investments became less palatable. And so and the invasion of Ukraine by Russia also put a big emphasis on energy security. And so I do not think that we're going to transition out of fossil fuels anytime soon. But also, I would say the following. I think that in my opinion, the transition will need both, because other factors, like, for example, AI, which is all over the news, as you know, and it's driving markets in a lot of countries around the world, require huge investments on data centers. These data centers, in order for this to work, cannot have power outages, and they require a lot of water. So a lot of investments like in power, just to feed those data centers, they have to have alternative generators, etc. So all of the energy needs for the next 10 to 20 years is huge. And you cannot, given the current infrastructure, really meet that demand with just renewables. So I do think that unfortunately we're going to have to rely on fossil fuels for a lot longer. The hope is that if we put enough pressure in these fossil fuel companies, is that they're also investing, because they're some of the biggest investors also in renewables, that we start seeing hand in hand, like the increase of renewables as a proportion of um, uh, the energy production and distribution.
Okay, we've run about 5 minutes over. We still have some questions, but I think we need to bring the session to a halt there. We will share those questions with you, Carla, offline, and so I hope we can get some of those questions answered as well. And
Excellent.
we'll look maybe to posting some of those responses also on the website. But thank you so much for that. Just to close up then. Just first of all, some thanks, obviously thanks to our sponsors, thanks to Carla for her input today. Just a brief look forward. Tomorrow we have a session on digital care, a maturing market but innovating just as quickly. On Thursday, pan-livery legacy from historical philanthropy to modern rehabilitation. And next Tuesday is big tech taking over our money. So lots of good content to come up. We look forward to seeing you all at future events, and do keep an eye on the website for upcoming things. So my thanks to our audience today. You've been great and really engaged, and we will try to make sure that we secure some answers to the questions we didn't quite reach today. And a huge round of thanks to Carla. Thank you so much for your input today. We've all learned something, and we're looking forward to continuing to follow this space. Thank you very much.
Thank you so much. Have a great day.